Okay, let's get started. So welcome to the tax update and strategies for British expats living in Thailand. I'm Carl Turner. I'm the co-founder of Expat Tax Thailand. The purpose of this presentation is just to provide you up-to-date information. And here at Expat Tax Thailand, we're here to help individuals understand their Thai tax filing needs so they can make better informed decisions. So we are a Thai registered, Thai majority owned company, specializing in working with expats to file their personal income taxes and provide ongoing advice. All of the accountants are authorized and regulated by the Federation of Accounting Professionals. So the areas that we'll discuss today, we'll go through what are the Thai income tax rules, what are the key dates. We'll go through what is taxable in Thailand and the definitive answer on who needs to file and who doesn't. Then we'll go through Thai allowances, deductions. We'll talk about the UK-Thai Double Taxation Agreement. We'll give some tips and strategies for UK asset holders, and then we'll go through case studies and a Q&A. So we've got many other videos and other resources on everything from pensions to capital gains to crypto gains. So there's many resources on our YouTube channel and on our website. So who's going to benefit from watching this webinar? So anyone with UK assets that are living in Thailand, and anyone who's looking to move or relocate from the UK to Thailand as well. So if you do have any further questions after this, you can look on our frequently asked questions page. We've got hundreds of questions that have been answered on there. And if you'd like to sign up to be kept up to date with any future changes, feel free to sign up to our tax alerts. So any changes like the CRS forms that are needed from KBank by the 20th of December, things like this sort of information, or any changes to the tax code will keep you updated. Quick disclaimer before we start, the content is for information purposes only. It doesn't constitute professional tax advice, shouldn't be acted upon in isolation, and it's just to explain the rules and it's not tax advice. So let's start with what tax changes have been announced. We'll quickly go through this. So the Revenue Department issued a revenue order to overrule previous rulings. It wasn't a law change. It was published in the Royal Gazette on the 6th of October last year. And it was regarding offshore income remitted to Thailand. And it came into force on the 1st of January. So it's a significant impact for Thai tax residents who remain in Thailand 180 days or more. And they bring in things like pensions or rental property income, investment capital gains and other assets, and they remit those to Thailand. So it's a big change. It'll affect anybody who's in Thailand 180 days or more in a calendar year, and most visa holders, so elite, retirement, education, business. The only exclusions are on the LTR visa. So the key dates for tax year and tax filing. So tax year started on the 1st of January. It's a calendar year. So it's the 1st of January to 31st of December. So the current year, if you've been here 180 days or more and you've brought in foreign source income, you need to file a tax return by the 8th of April online or paper-based 31st of March next year. So this has all been announced. There's been official announcements from the revenue that these changes have gone ahead. We've actually got an interview with the Revenue Department that we're about to launch as well. So there's official documents put out in July to explain exactly how foreigners living in Thailand pay tax and how these rule changes will affect them. So let's talk through who doesn't need to file and a definitive answer on who doesn't need to file a Thai tax return. So if you spend less than 180 days in Thailand and you have no domestic income, so that means no Thai rental property income or no salary in Thailand, or you stay 180 days or more and you bring in less than the minimum threshold to file, or you spend pre-2024 cash in the bank, or you've got an excluded income source due to the double taxation agreement, then you don't need to file a tax return. So what are the excluded income sources that are relevant for Brits? So if you've got a UK civil service pension or armed forces pension, we'll go through this in the Q&A. We've got a few Examples for this. If you've got cash that you've sent across that was in your bank account as of the end of 2023, that's an excluded income source. Or if you've got an investment or a property that's lost money, you sell it and bring it into Thailand, that's not assessable income because it's not made a gain. So who does need to file a tax return? So if you have a domestic income, so Thai rental property or a salary, you have to file a tax return. Or if you stay in Thailand 180 days in a calendar year, not consecutive, but throughout the year, and you bring in, remit, transfer, spend overseas income sources above the minimum threshold. So these can be income sources like overseas pensions, dividends, salary, investment capital gains, rental property income, property sale. What if you've already been taxed already? So if you've got tax already paid on your, let's say, UK assets, then you may be able to claim the tax credits on the tax paid, depending on the double taxation agreement. We'll explain that later. You still have to file a tax return unless your income source is excluded, like civil service pensions, for example, or it's cash in the bank you've brought in. And the filing threshold, we get asked this a lot. What's the maximum I can bring in without having to file a tax return? So for pensions, if you're married and you joint filing, it's 220,000 Thai baht. If you're single, it's 120 a year. And for all other types of income, like overseas rental property income or dividends or investment gains, it's 120,000 you can bring in a year if you're filing jointly, and 60,000 if you're single. So let's talk about what is this foreign source income? What are the types of income sources that are taxable if they're brought into Thailand? So this is section 40 of the Thai Revenue Code. There's 8 different parts, and you can see on there that pensions and salary are noted on there, investment capital gains, dividends, Thai rental property rental income, whether that's in Thailand or overseas if you bring it in, property sale. So they're all included on there. So what isn't taxable? We'll just recap and go through that again. So overseas assets that you don't remit. Remember, Thailand is a remittance tax basis. So even if you have an income overseas and you don't bring it in, remit into Thailand, spend in Thailand, then you don't need to file a Thai tax return. It's not assessable income in Thailand if it's not remitted into Thailand or spent in Thailand. Prior year remittance. So what does this mean? It means cash in the bank from 2023 can be brought in anytime in the future. We touched on earlier, if you've made a loss from your investments, then you can bring that in. That's not assessable income. Overseas inheritance, that's not taxable. Civil service pensions like military pensions, or if you've worked for the UK government. Gifts and loans, which is quite complex. And if you're a non-resident, so less than 180 days, then if you bring in funds, then it's not assessable income. So does everyone have to file? Well, no, only if you have assessable income in Thailand or you've got domestic income. So assessable income, 180 days or more, and you've brought in foreign sourced income, or domestic income if you've got rental property income, for example. If you don't meet the criteria, then you don't need to file, and you don't need a tax ID number. You only need to file if you've either got domestic income or you've remitted, brought in overseas income over the minimum thresholds. So yeah, exactly what I mentioned. Assessable income, if it's remitted, need to file a tax return over and above the thresholds. And if you've got exempt income, you don't need to file that. So how do you file if you do need to file? First of all, you need a tax ID number. You can get that from your local tax office or via Expat Tax Thailand. We have a service for this. Then you need to file a PND 90 tax return by the 8th of April for the current year. You can file that yourself, or for example, we have an online filing service. So our TIN service, we can do everything remote to obtain people's tax ID numbers if they need one. And obviously we have our online filing service for all circumstances through our online client portal. So whether you need to claim tax credits or not, we have a service available for that, or if it's simple and just bringing in a small amount of pension, or if it's complicated and you need advice. So let's talk about tax credits and what this actually means. So a double taxation agreement means the UK-Thai double taxation agreement means you can potentially use tax paid on your UK assets as a tax credit against the Thai personal income tax. So you may be entitled to use a credit, but it still means you have to file a tax return if you bring those assets into Thailand. So the main purpose of a double taxation agreement doesn't mean you don't have to file. It doesn't mean you don't have any tax. It just means that it clearly sets out who can tax the assets and how. It means that you've got a clear understanding. It takes precedent over local rules. So that's why things like civil service pensions are excluded. We've actually got a 1-hour webinar to discuss the UK-Thai double taxation agreement with a UK chartered tax advisor. And also, if you do have assets in other jurisdictions, we've researched all 61 double taxation agreements. And we've got specific videos for many different countries. So if you've got assets in different countries, it might be worthwhile looking at our YouTube channel. So some simple strategies to start with. You should really track the remittances that you bring it in and spend it in Thailand, and use non-assessable income sources first. So cash in the bank from previous years, for example, or if you've got a civil service pension, for example, use that first. And the double taxation agreement takes precedent over local domestic tax rules. So how will it work in practice for UK nationals? So UK pensions, so UK state pension or private pension, if they are remitted, so transferred to Thailand, they are taxable in Thailand for Thai tax residents. You can use any tax paid on this as a tax credit, but if you spend those pensions in Thailand and you're in Thailand 180 days or more, you need to file a Thai tax return. You can use the tax paid as a tax credit. If you've got investment capital gains and you bring those into Thailand, they are classed as assessable income. They're potentially taxable in Thailand. Again, if you've paid tax on those capital gains, you can use that as a tax credit for UK, but you need to file that and claim that. And also rental property income. So if you've got a UK property that you rent out, if you bring the income into Thailand, you can offset some or all of the tax with the tax that's been paid in the UK. Dividends, exactly the same. So you can, if you bring it into Thailand, it's taxable. You can offset with any tax that you've paid in the UK. So once you've calculated, what is assessable income, what isn't, and you calculate, you've got the actual assessable income figure, then we look at the common allowances. So everybody gets a personal allowance, 60,000 Thai baht. If you're married and your spouse doesn't have an income, regardless of where they're from, you get their allowance as well, 60,000 Thai baht. If you've got children, you can claim 30,000 for the first child, and then 60,000 onwards after 2018. The increases if they're born after 2018. Health insurance, you can claim up to 25,000 Thai baht if it's a Thai insurance company, not an international one. And life insurance as well, up to 100,000 Thai baht if you meet the criteria. Also, if you're 65 or older, you get an extra 190,000 age allowance on top of this. So once you've added up all of your allowances and deductions, then you look at the income tax brackets. So you get your assessable income, deduct off all your allowances and deductions, and then we look at the tax table. So the first 150,000 is tax exempt, and then it's progressive like the UK, but with more steps. So first bracket's 5%, it goes all the way up to 35% over 5 million Thai baht above your allowances and deductions. But that's only for assessable income, not everything you bring in. So some simple tips and strategies. So it's really important that you calculate the potential income tax for all the different asset classes, because they are taxed, they could potentially tax differently. You can see if you've got tax credits for the different types of income. So you can potentially use the tax paid in the UK to claim as a tax credit. You really need to keep a good record and track whatever you're transferring in, because we have to claim that tax back, the tax credit. So it's important that you keep a very good record. And in my opinion, it's better to separate out the income sources overseas if it's possible, because then when you transfer that across, however you send the funds to here, you can easily demonstrate where those funds were from. And then it's easy for the tax calculations to work out what is income, what isn't income, and what the potential tax credits are. You can also use cash in the bank from previous years and then use your assessable income sources. If you've got a high tax rate on certain assets, it might be better in the UK. So for example, if you've got a lot of rental property incomes or a UK pension, and you're already paying quite a lot of tax at source, they might be good assets to bring in rather than, say, investment capital gains if you don't have tax on those, because you can use the tax paid as a tax credit, you see. So you've got to be a bit smart what you bring in and do the assessment. We can happily help with people to assess what they should bring in and how to deal with this with our accountants. So if you bring in investment losses or low capital gains, that might be a good option as well, so that you can reduce down your assessable income. Just remember, we are here to help. We've got many videos on this to explain this. You can also book in a free consultation just to go through this in detail and look at your tax calculations. So let's go through a few case studies. So we've got two examples here I think we're good to go through. So one is someone who stays less than 180 days in Thailand, and they sell a property in the year when they spend less than 180 days in Thailand. So they sell a UK property, and the next year they spend more than 180 days in Thailand, and they bring in the money from the property sale from the previous year. So the capital gains is 50% capital gain. Well, in this example, because they sold the asset in a non-Thai tax year and they've remitted in effect cash in the bank from previous years, then there's no reporting and no tax on this, because it was an asset that was sold in a non-Thai tax year. It's not assessable income in Thailand. So it means they wouldn't need a tax ID number and they don't need to file a Thai tax return for that asset. So let's give an example where someone does need to file a tax return. So 65-year-old, they sell shares in an UK equity ISA. So equity ISAs are the same as investment portfolios in terms of you are taxed on the capital gains. Same as if you move to, say, Spain, ISAs are not tax exempt in Thailand and they're not in other countries as well. There's no specific exclusion on the double taxation agreement, you see. So we look at ISAs the same as any other investment with a capital gain. So let's assume this person sells the investments this year. They've been in Thailand more than 180 days. They sell £40,000 of tech shares, and they've got an all-time gain of 40% on those shares. So they sell this 40,000, so it's 1.7 million Thai baht, and we know there's a 40% capital gain. How much tax is there in Thailand if they bring all that money into Thailand with their allowances and deductions? First of all, we need to work out what's the original capital and what is the capital gain. So with that £40,000, we'll convert to Thai baht because obviously it's been sent across. So it's 1.7 million. We divide that by 1.4, which is the gain percentage, and that is the original capital. So 1.2 million of the 1.7 is original capital, and the remainder, so 487,000, is the capital gain. So we will put down on the tax return 487,000 Thai baht as the assessable income. So if someone brings in, you can't decide yourself if you just bring in the capital or the gain. It's a percentage of whatever you bring in. So on the tax return, this is how it looks, quite small, but okay, I'll explain it. So this person's 65, so they get their spouse allowance, their allowance, the personal allowance, and the age allowance. So they get, let's have a look on there. Can't really see that very well. They get 310,000 of allowances. And then the taxable assessable income's 487,000. So if you look on the tax tables, the tax would be 1,367 baht. So that's how we calculate it. If you would like to go through a free tax calculation session, feel free to book in with one of my colleagues, Jason or John, who can go through this online and go through the tax calculator to give you an assessment about how this might impact yourself. So I do recommend people sign up for our tax alerts because there may be further changes to the revenue code regarding worldwide income. You'd be the first one to know with any future changes. And if people do need a more detailed conversation, we do offer tax consultations, 1-hour sessions. What are the implications of not declaring tax in Thailand? So like all revenue departments, the penalties are quite harsh if people fail to declare a tax. So if they file late, there's a surcharge of 1.5% for every month cumulative since the tax was owed. If people do not file a tax return and they're audited, then they can have a penalty up to 200% of the tax that is owed on top. And obviously, if people don't pay the tax eventually, they're going to get a fine also up to 200,000 Thai baht on top. And if people don't then pay the tax, then obviously there's harsher penalties like imprisonment, same as all tax and revenue departments. So the revenue are taking this quite serious. We've had an interview with the revenue department, and yes, they're expecting people to file if they have remitted in foreign source income. So let's go into the questions. We've got quite a few that have come in by email. Then we'll go through the questions that have come in on the live video. So first question, is my UK public service pension and UK state pension exempt from tax in Thailand? I've since looked at the UK tax treaty and found it mentions government services. Okay, yeah, so very good point. So civil service pensions, like we mentioned earlier, yes, they are excluded. There's no need to file on a Thai tax return. It's not assessable income, it's excluded. But UK state pension, this is not excluded. You need to file for UK state pension if it is transferred into Thailand. If that is your only income source, then with your allowances and deductions in Thailand, then it's likely you'll have to file a tax return, but you will have no tax to pay or minimum tax, but you still have to file a tax return. Government pensions, yeah, it's known as government service. This doesn't include state pension, but there is a list of pensions which are included in this. So civil service, armed forces, Royal Navy, firefighters, police, NHS, teachers, local government, judicial pensions, parliamentary pensions. So these are all excluded under the Double Taxation Agreement. If you like more information, I recommend you do go on to and watch the DTA video. We do explain this in a bit more detail. Next question. So do we have any write-off stroke deductions for medical expenses? So we get asked this quite a lot. The only thing you can do is if you've got a Thai local medical insurance plan, you can deduct up to 25,000 baht from your taxes. If the premium's more, then you can only claim 25,000. So no, you can't write off medical costs. What do you say to all my British friends living here that tell me they're just going to ignore this and that they don't have the manpower or technology to catch them? Well, things are changing quite dramatically with Thailand signing up to common reporting standards. All the information is already available to them from all of the UK assets, pensions, bank accounts, investment providers. They already provide all the information every year, account balances, transactions, ins and outs to the UK HMRC. And then UK HMRC send that every year in an XLS file to Thailand. So they already receive that data. So if people don't adhere to the local rules, then, ignorance is not an excuse. So yeah, people should really look at following the rules of the remitting in foreign source income. A couple of questions here. This year, no money was brought into Thailand. Must I register for TIN and file anyway? I have no assessable income and I won't owe tax for this year. A good question. No, if you don't have assessable income and you don't meet the criteria to file, you do not need a tax ID number and you do not need to file. For next year, I will live on my UK state pension. So they get £9,600. Must I file? Yeah, if they bring that in, they will need, and they live in Thailand 180 days or more, they will need to file a Thai tax return. But as I mentioned, with the allowances deductions, it's likely, if that's the only income source, it'll be a filing job administration issue rather than a punitive tax issue. So my wife, 57, I'm 70, started living in Thailand around 2020. Got a final salary pension in the UK, £4,000 a month. We live off some of this income in Thailand. I'm interested to know what my tax liability is likely to be if I bring in £2,500. So I'll transfer that to my Bangkok bank. Can I split this and minimize my tax by transferring some to my wife? No, you can't. If it's your income and you're a Thai tax resident, even if you send it to your wife or you send it to a third party or for the rent, it's still you remitting in your income. So you can't split it between yourself and your wife. But okay, we'll look at the amount they bring it in. So the good thing, well, in the UK, it's likely they've got a high tax rate on there already if they've got 48,000 in pensions. So that means they've got a lot of tax already paid as a tax credit. So if they're only bringing in 2,500 a month, but they've actually got 4,000 income in the UK. Let's have a look on here. So yeah, so if you're bringing in £4,000 average tax, so if you're earning £4,000 in the UK, the average tax rate is about 14%. So if you bring it in £2,500 per month, then on the tax calculator, if you look at what needs to be filed in Thailand, you can see the tax that would be owed on that on 2,500 a month, which is what is it per month? Let's have a look. My eyes are 1.3 million Thai baht a year. You can see it's 100,000 Thai baht of tax, but you can see the tax rate's 7.5%. So you can see the UK rate of tax on this amount's double. So it would be a filing job again. So we've got an assisted tax filing service for claiming back tax credits and filing compliantly. So that's our middle plan, assisted tax filing, where we would file online, claim back the tax for clients so that they don't have to pay tax if they've paid tax in the UK. So that's one of the services that we offer. Obviously, if people would like consultation as well, we can help with that and obtaining tax ID numbers. We are here to help. If you do have questions, let's say I recommend checking out the frequently asked questions section. If you do send us a question, we now have a Q&A webinar every week to answer questions live. So let's get on to the questions that have come in. So let me just change my view on the screen and then I can actually answer them on the screen. So bear with me 1 second. Okay, I think we're ready. Okay. So let's get on to these questions. We've got many. Okay. I'll go through them just in order. If there's any that I don't get to, I'll make sure that I answer individually. So I'll put them on the screen so it's easy to read. Obviously, they're anonymous. I have a retirement visa, but spend less than 180 days in Thailand. How much money can I bring in? So if you're a non-Thai tax resident, then whatever you remit in is not assessable income in Thailand. So I hope that answers the question. I think we answered that within the webinar. I'll start with the last questions first, because I think a lot of these were answered in the okay. Has any distinction been made for remitting money to buy property? Property developers are telling people that such remittances will not be taxed. If the majority of people that are buying properties in Thailand a non-Thai tax residence. That's the reality. So I think that's maybe why they've mentioned that such remittances are not taxed. But if someone is a Thai tax resident in the year that they disinvest assets to transfer into Thailand, then they can potentially have a tax liability. There's no exemption for property purchases. So it depends on a case-by-case basis whether they have made it, if they're bringing in foreign source income or not. Okay, I've got a question about UK NT tax code. Can I turn my UK SIPP into an international SIPP so that I can get an NT tax code and then just pay Thai tax on drawdown of the SIPP, which is much less? I don't know if you can move that into an international SIPP and get an NT tax code. One of the pension trustees that we work closely with, they mentioned that of all clients in Thailand that have got SIPPs, they don't have any that have got an NT tax code that have applied within the last 20 years. So it might be quite difficult to get an NT tax code on there. Yeah, so I don't know if that helps. Okay. I remit UK taxed pension income to Thai bank and spend it. I also draw cash from an ATM from a UK bank, and I also spend on UK-based credit card. Must it all be declared? Good question. So the UK tax pension income that you transfer, yes, 100%. If you live in Thailand 180 days or more, and you bring in more than 220,000 Thai baht of pension income and you're married when you file in jointly, or 120,000 if you're single, you need to file that on a Thai tax return. The other ones, I don't know. So it depends on the source of the money. If you draw the cash from an ATM machine from a UK account, it depends on the source of the money that's in your UK account. If you can show the money was there pre-2024, then that's not assessable income. Using the UK credit card, it depends on what you pay off the credit card with. If you're using the credit card and you are paying it off with potentially taxable money, then yes, that's tax avoidance. So yes, that must be declared in a tax return as being remittance. If you're using a credit card just because it's simple and you're paying it off with cash in the bank from previous years, then no. So on this case, some yes, some maybe not. I hope that's useful. Go for a few more. Right. Thanks, you answered on my next slide. I remit all my police pension and a little more, which amounts to less than my allowance in Thailand. Do I still need to file? No. So if you're bringing in less than the threshold to file, then you don't need to file. Hope that's useful. Got a few more questions, just trying to read ones that I've not answered already. Right, yeah, very good question. So can the 180 days in Thai tax year be mixed, i.e. not consecutive? So it's not 180 days in a row, it's just 180 days in a calendar year. So you can be in Thailand for the first 2 months, leave, and then come back. If the total is 180 days or more, then you're a Thai tax resident. Right. Spending less than 180 days in Thailand. During this time, I make money from a UK limited company. Remit the money earned during this time. No requirement to file Thai tax return. Yeah, as long as the work wasn't classed as being conducted in Thailand, then there's no tax liability for receiving the income because you're not a Thai tax resident. Depending only if the work was conducted in Thailand. Yeah, that's the only area where that might be taxed. Right, okay. Not clear on when you need to pay versus when you submit the tax return. Okay, so let me explain that in a bit more detail. So if you the tax year runs 1st of January to 31st of December. You need to file a tax return for that year by the 31st of March if you're filing paper-based at the Revenue Office, or if you file online or with our service, we can file up to the 8th of April. You then be given time period to pay the tax if you've got tax to be owed, or yeah, so it depends if you're claiming tax credits or not. So you would pay the tax after you've submitted the tax return. You get leeway of 4 weeks to pay. One question that probably needs answering with a bit more detail. If I've got capital gain from an asset owned from a long time ago, I thought the taxable gain in Thailand was just the gain from the 1st of January 2024, and not the full gain from the purchase date many years ago. No, it's all-time gains. It's not from the 1st of January. The only exemption is cash in the bank from previous years. So the 31st of December 2023 is the value for your cash balances, not for investments, not for properties. We've got a webinar on capital gains if you'd like to go through that in more detail. Let's look at this question. I think I answered this, but okay, I'll go for it. If I have a child at a fee-paying school, can I send the fees to him from abroad for him to pay directly to the school tax-free? You can send to whoever you please, but if you bring it in remittable, if you're borrowing in foreign source income, then it's still income. It doesn't matter where it's sent to. So if you bring it in assets that are not taxable, then fine. But if you bring it in, if you are sending foreign source income and you're a Thai tax resident, then yeah, you may have a tax filing obligation depending on what you bring it in. Need a bit more detail. Very good point. So on the allowances and deductions, if you bring it in pension, you can claim up to 100,000 Thai baht as an allowance on top of the normal allowances. I think I put that in the calculation on the figures, but yeah, thanks for that. Good point. Yeah, good question on how will we know? How does the Thai government know if the money is from previous year or from inheritance, for example? Do we need to prove this? Yeah, so it's up to the taxpayer or the tax resident to be able to prove and justify this. If it is non-assessable income, you don't need to file that. You just need to keep a very good record. So it's up to the individual to be able to prove under audit that this money is from whatever source it's from. So it's important to keep very good records and really document everything. You can be audited up to 5 years. So you need to keep records for at least 5 years, good records. We'll look at a few more questions. Right, okay, let's look at this question. I didn't really check. Creating typos, same question. Okay, let's delete that part. Okay, if I manage the year when I remit money to Thailand, and so I am in Thailand less than 180 days, can I bring in whatever I like in that year? And then for all of the years, I will be in Thailand practically full time over 11 months in each calendar year. I assume this means if you are a non-Thai tax resident, can you remit in funds to Thailand? Yeah, if you're a non-Thai tax resident, then if you make a income in those years, then that's not assessable income in Thailand because you're a non-Thai tax resident. Okay, question about inheritance tax. So you said inheritance is not assessable income. How does this relate to the previous webinar? I recollect you saying, yeah, IHT in Thailand is at 5%. Yeah, okay. So if it's overseas inheritance, and it's not Thai-based assets, then there's no inheritance, no tax on the inheritance that's received. But if it's a Thai domestic inheritance over 100 million Thai baht per beneficiary, then it's 5% tax on anything that's received over this per beneficiary. So I hope that helps clear that up. Have a UK local government pension is considered UK civil service? Yes, I answered that on the on there. I think it was one of the first questions that came in actually. Okay, so any more? Right, what is meant by, okay, clear. What is meant by cash balances? E.g., 2024, I sell a house in the UK, I put this cash in the bank in 2024 and transfer this in 2025. Is this still taxable? Yes. If, well, it depends. If you're a Thai tax resident in the year that you sell the property, then yes. It's only a one-time, in the year that you're a non-Thai tax resident, then the year that you become a Thai tax resident, you look at the cash balances from the previous year. And they actually announced in November last year that they would allow all cash balances as of the 31st of December 2023 to be able to be brought in anytime in the future. So this example, I need a bit more background, but if you sell the property in a Thai tax year and you bring that into Thailand anytime in the future, it's assessable income. Hope that clears up. I don't know if that answers that question. So is there any more questions? Let's look at some of the ones at the start. I think that's all the questions. So thanks for that. If there's any missing, feel free to send that by email. Okay, one more question. Let's go on. It's quite interesting. I have a Singapore HSBC bank. Does Singapore, Thailand have a double taxation agreement? Yeah, it does have a double DTA. So if you've paid, so for the Singapore Thai DTA, you've got to look at the specific asset that you've got that you're bringing in. It might mean you can use the credits for any tax paid there. Yes, that might be helpful. Okay. Okay, one question about allowances. Let's go through these. I'm happy to go through them. I received a UK tax pension. My allowance is 60,000 plus 120 plus first 150 is zero tax. So my remit less than 330, I need to file. Yeah, so just be okay. The limit to have to file, I assume they're married because, well, I don't know on this example. If they're married, then if you bring it in more than 220,000 of pension, you have to file a tax return, regardless if you've got tax to pay or not. If you are single, then it's 120,000 that you can bring in before you have to file. So the amount of tax that's owed is irrelevant for having to file. But yeah, on this example, I don't know the age, I don't know if they're married, but yeah, they would get the personal allowance, plus they would get 100,000 Thai baht. Not married. Okay, that's clear. So they get 60,000 plus 100,000, and depending on their age, if they're under 65, then they wouldn't get anything extra. Yeah, they get 150,000 tax at zero. Yeah, 63. So yeah, thank you for that. So yeah, you would get 60,000 plus 100,000 plus the 150,000 before you'd pay tax, but you still have to file a Thai tax return. So for a lot of people, if you're bringing in low income amounts, then it's more of a administration issue rather than a tax issue. And if you have got a large UK pension and you tax at source, then it's again an admin issue, having to claim back tax credits rather than a tax issue, depending on your assets and how they're positioned. So I hope that's been useful. And if you've got any questions, feel free to reach out. Yeah, we are here to help. We've got many questions, and every week now we're going to do a Q&A session where we will go through questions that we receive live. So that might be quite useful to join. We'll put them all on YouTube as well. So any other questions, feel free to reach out at info@expattaxthailand.com. Thanks for watching. See you again soon. Bye-bye.